Everyone thought blockchain would fix trade finance. Big platforms have launched, big brands joined. And then, many of those projects quietly shut down. But at the same time, a second wave of projects has started to work, where concrete tools that solved one painful problem really well. In this video, we'll look at 4 simple questions. Where did the idea of doing trade finance on blockchain come from? What actually happened to all those projects? We'll look at both the good and bad and try to learn something from them. And finally, will new rules, new standards and new tech give this space a real boost in the next few years? This video is brought to you by Espeo software. We are a blockchain consultancy specializing in blockchain payments, asset tokenization and DLT projects. If you're exploring your first blockchain proof of concept in trade finance and you're not sure where to start, we can help. Visit espeo.eu and schedule a consultation with our team. You'll find all the links in the description. Let's start with the basics. Trade finance today still runs on paper and PDFs, letters of credit, bills of lading, invoices and certificates. These documents move between banks, shipping lines, buyers, sellers, insurers and customs. They move slowly. They get lost, they get copied, they can be forged, and every side keeps their own vision of the truth in their own systems. So when blockchain arrived, the pitch sounded perfect. Put the key documents and key events on shared ledger, make them tamper-proof and visible to all the parties who need to see them. And then use smart contracts to automate checks and payments. Early pilots seemed to prove the point. A few banks ran the first blockchain-based letters of credit. Shipping documents that used to take days to process suddenly took hours. Everyone could see the same data and audits were easier. On the back of this, a big idea took hold. Global conglomerates began building shared blockchain platforms for global trade. The idea was that all these banks and logistics players would come together and it would finally be possible to digitize the whole journey from purchase order to shipment to payment. That's how we got projects like TradeLens in shipping, and consortia like WeTrade, Polo and Contour in trade finance. The vision was bold, but reality turned out to be much more complicated. Let's look at the first wave of big platforms. TradeLens, built by Maersk and IBM, wanted to be the global logistics operating system. It onboarded many ports and custom authorities, and it actually did real work. But after some years, it shut down. Why? In simple words, the economics and the politics did not line up. Some competitors were worried that the platform was too closely linked to one carrier. Others did not see enough value to justify the cost and effort of integration. Some parties earned money from handling paper and did not like a system that could cut them out. On the banking side, WeTrade, Polo and Contour all aimed to digitize trade finance on shared ledgers. They connected group of banks, but they struggled to get to really large volumes. After some time, funding dried up. Several other consortia went into insolvency or had to shut down operations. So if we stopped here, the story would sound like blockchain in trade finance tried and failed. But that is only half of the picture. At the same time, smaller, more focused solutions began to get traction. Electronic bills of lading, or eBLs. A bill of lading is the document that proves ownership of a shipment. If you control the bill of lading, you control the cargo. It is central to trade and to trade finance. Carriers and standard-setting bodies have now made strong public commitments to move to eBLs. They have set targets to reach high levels of eBL adoption by 2030. And, importantly, multiple platforms are now live that allow shippers and banks to issue, transfer and surrender eBLs digitally. Some of these platforms use blockchain under the hood. Volumes are still small compared to the whole market, but they are growing. And the key point is, the industry is not trying to digitize everything at once. It starts with one document that really matters and makes it digital in a legally robust way. Fraud and duplicate financing checks. One of the silent problems in trade finance is that the same invoice or the same shipment can be financed twice by different lenders. If lenders cannot see each other's positions, this is hard to detect. Here, blockchain has been used in a more modest way. Banks can check new financing requests against this registry. They don't see competitors' data, but they can see if something has been financed elsewhere. This has already gone live through normal banking rails. Banks can access such services via existing APIs and networks such as Swift. No need to join a big new platform. That's a very different go-to-market model. In some countries, the government now requires importers to submit documents digitally through a specific gateway. Some of those gateways are blockchain-based, and because they are mandatory, adoption follows. In these cases, the value is clear. Lower risk for the state, faster clearance for traders.
Let's boil down the main lessons from the last few years. For me, the most important lesson is that governance beats technology. Who controls the network matters as much as what runs under the hood, even if it is decentralized. If competitors feel that one player has too much power, they will hesitate to join no matter how good the technology is. If I were to suggest how to approach building a blockchain product for trade finance, I'd start with just one painful document or risk. Projects that focus on one thing, like the bill of lading or duplicate financing, are easier to explain, easier to integrate, and easier to justify in a business case. I would also consider the timing of launching these products. Many early projects try to digitize documents that, in law, still had to be on paper. If this is your case, I would suggest shifting your focus towards supporting councils and associations that lobby for standardization initiatives on the global stage. Standardization is the key to digitizing this sector. If every platform has its own data model and its own way to represent a bill of lading or an invoice or a certificate, then each integration is a mini project. I think the industry has learned that we first need shared standards for data and for APIs. Platforms that build on those standards will have a much easier time connecting to each other. One more thing, digitization often shifts who does the work and who gets paid. If your platform cuts out intermediaries without giving them a new role, don't be surprised if they try to block it. Projects that work either give everyone a clear benefit or they are backed by regulation that simply forces the industry forward. These are not very glamorous lessons, but they are honest. And they show why the second wave of trade finance blockchain will require a lot of effort in coming up with common standards and processes. Luckily, the landscape is shifting. First, the legal landscape is changing in ways that will help. Some major jurisdictions have now passed laws that recognize electronic trade documents. That includes things like electronic bills of lading, electronic bills of exchange, or digital promissory notes. In simple words, many electronic documents can now, in some places, be treated just like paper in many courts. This is a huge shift. It means that digital documents can carry a title and can be pledged as collateral in a way that is legally robust. Banks can finance against them with more confidence. Carriers and shippers can move away from paper without fearing that the judge will throw out the case. Second, industry standards have matured. We now have fairly detailed standards for what data should be inside key trade documents. We also have standard APIs from industry bodies that tell platforms how to talk to each other. And we also see strong commitments from big carriers to move away from paper bills of lading on a clear timeline. When the companies that actually move the cargo change how they operate, everyone else has to adapt, including banks and insurers. What is also very important is that the payment and settlement layer is evolving as well. We have done many videos on this subject already, so please be sure to check them out. But in short, we see new projects where banks use tokenized money on shared ledgers to settle payments 24/7 across borders with finality. These systems are usually built together with regulators and central banks. Over time, they can plug into digital trade workflows. So, will new rules and technologies give blockchain trade finance a bigger boost? Our view is yes, but only in specific focused areas. We are not going back to the one global platform that solves everything. Instead, we will see a network of networks. Some will focus on documents, some will focus on fraud and risk, some will focus on payments and settlement. And they will talk to each other through standards and APIs. What does this mean for you? If you work at the bank, a shipping line, a fintech, or a corporate treasury, the message is: don't wait for one magic platform. Instead, look for focused tools that can plug into the systems you already have. Start with the documents and risks that matter most to your business, and make sure whatever you build or buy is based on open standards and can interoperate. If you want help thinking through your own use case, this is what we do at Espeo Software. We help banks, fintechs, and corporates design and build realistic blockchain projects in payments and trade. You can find a link to talk to our team in the description. If you found this video useful, please like and subscribe and let us know in the comments which part of trade finance you would like us to explore next. Thanks for watching. Stay on the block to stay ahead.